Portia, Tate, and Jaden Guerrero. So welcome aboard. I'm Professor Strafacci. I've been teaching at Rasmussen and setting up classes for quite a while now. It's been great. I like the school a lot. It's really a wonderful place. Do a great job. Let's go through some of the work. Let's go through what we have to do in this particular class. So I want to share my screen. And a lot of information here that I don't need. Okay, and more information I don't need. And more information. And more information. All right, here we go. So money to banking, you have my announcements. I'm going to call them up again. So our class dates are here. The class started on the 13th. The initial discussion was due on the 16th. There's only 3 of us, so please stay on top of it. And the last day of the term would be 9/19. I'm not sure if that's correct. It should be correct. Let's see, 9/19. Yeah, it's about right. Okay, and this is my accounting playlist. So if you want to give yourself a refresher on accounting, you could just watch these videos. And what it'll do is it'll take you through the accounting spreadsheet. So let's watch just one on the income statement so you could familiarize yourself, and then you could watch the other 2 on your own. So I'm going to share that again with a little sound. Let's give it a shot. This is the first in a series of kind of a review of the basic accounting theory. This kind of works with finance classes. It also is very helpful if you're an accounting major. Either way, it's really helpful. You know, as I have degrees in accounting, economics, and finance, I try to bring it all together, and I teach statistics. I try to get it all together and present it in one format. So I've created this fictional company, Tom's River Corp, and there'll be 3 or 4 parts to this series because I want to start with the income statement. Then we'll do the balance sheet, retained earnings, statement of cash flows, and an overview. But if we look at, let's focus, and this is an interactive spreadsheet, and that's why I created it, because by using it, you get an idea of how how these statements should actually flow. So we see that on the income statement, and every company has an income statement, whether it's a small mom and pop business or it's the Coca-Cola Corporation or the International Business Machines Corporation. Either way, you are going to see an income statement. We'll get into the balance sheet in the next video. But here we have sales of, well, it's all in thousands, and you always want to watch out for that too when you're studying. So this is in thousands. So the sales for this company would be approximately $3,074,000. And if we take out the cost of goods sold, and watch up here, because that's, for those of you who have a good knowledge of Excel, you'll appreciate this. And if you don't, this is a chance for you to start to begin learning Excel. The cost of goods sold in this issue is $2,088,000. So when you subtract what it costs the raw materials to create these sales, and this is obviously something like a manufacturing company, service companies, finance companies are going to look a little different. And obviously that's why you have to keep studying to learn the different nuances. But at the end of the day, it all looks the same. So gross profits are $986,000, and notice up here, I subtracted sales from cost of goods sold. Now we take out our operating expenses. So selling expenses would basically be commissions, what you pay salespeople. Maybe you outsourced your sales. However that worked, the accountant would plug this into selling expense. Administrative expenses would obviously be legal, accounting, overall administration of the firm. And the reason why we break these out is we want to see what our profit margin is versus what our raw material cost is. And not just, and we're going to learn this in further videos, when we look at ratio analysis, we don't just compare our cost of goods sold on an absolute basis. We look at it relative to other companies within the industry. So for instance, in some industries, cost of goods sold might naturally be very high, and the company makes money on financing or different things. Here, in this particular industry, and we just made up this industry, we hope that this ratio of 986 to 3074 is commensurate with the other companies within the industry and makes sense for that industry. And if it changes or varies by much, we're going to want to ask that question. So these numbers kind of are included where you start asking questions. Another expense might be the leases that we have on automobiles, on different copiers, things like that. And then a very important number is depreciation, which I'm going to spend some time in a different video on depreciation because it's such an important part of the of understanding finance. But basically and quickly, the government urges us to start businesses and create businesses because when we create businesses, we create work, we increase the GDP, and we have more people who are out in the workforce paying taxes. And that's going to be another video. But what happens is when you build a building, when you do anything of a capital expenditure, a building, a truck, anything you buy, the government allows you to write it down against your earnings. So it becomes a non-cash expense because you've already spent the money, but you're able to deduct it from your earnings so you pay less taxes. So again, this is a video for another time, but to some, it's like your mortgage. You don't actually pay the entire mortgage. You're paying the mortgage less the amount you deduct from your taxes. So depreciation is a way for the government to encourage us to invest in different things. So we get to deduct it from our taxes, and that becomes part of our expenses.
So I'm going to stop there, but you get an idea. You could watch these. You could watch these and really get a good view of the accounting, and then call up my interactive spreadsheet, and you can actually follow the whole system right through. So that's something I want you to be aware of. This is my welcome. And you have links to the Learning Center, the library, the Writing Lab, tech support. So if you need anything, it's right there. Check your announcements. Always post an introduction. Check your calendar. Everything will be there for you. And then this is week 1 guidance. So the purpose is to develop a foundational understanding of the financial system. You're going to learn about the different components of the financial system, the institutions, the markets, the instruments. You're going to explain the evolution and the function of money. What is money? Money serves 3 purposes in an economy. 1, it's a medium of exchange. So we take it, we earn it, or we invest for it, or we inherit it, or however we come by money, and we use it to buy other things. The other is it's a store of value. As you're saving money for retirement, or you're saving money to buy a house or a car, it shows you a number that, basically an amount or a number that you are acquiring to get whatever you need. Store of value explains to us what we're gaining by way deferring happiness, right? Because think about it, most human beings, if they thought the world was going to end tomorrow, God forbid, they'd spend everything they had. But because we don't believe that, and we want to, the incentive, humans need incentives, and the incentive would be to defer that happiness and save the money. Well, what are you getting for that? I mean, what are you giving me if I save it and not use it today? That would be the store of value, the interest rates. And the third would be a unit of account. So when you're creating a budget or trying to decide if something is worth something, or you want to know what's the relative value of my rent or my mortgage versus my utility bills, you can measure it in money. So we're going to talk about that and the relationship in an economy. We're going to talk about debt instruments and interest rates, and we're going to formulate the key factors that determine interest rates. So in the beginning, you're going to create a 2 to 3 page educational guide designed for you junior analysts, and you're going to explain the 6 core areas from reading, the role of financial institutions, primary and secondary markets. Primary markets are when a company goes public and raises capital. The IPO, the initial public offering, when they actually raise the capital, is the primary market. And then all you see in the stock market is people just trading the stock back and forth, like eBay. That's all that is. That's the secondary market. You're going to look at the difference between stocks, which is ownership in companies, and bonds, which is companies, corporations, government borrowing money, and derivatives, which are ways to kind of play the up or down movements of bonds or stocks by using investments that are tied to that. Think of it like like a bet. You don't actually play for the Giants, so you don't actually play for the Vikings, but a derivative is the bet you're making on them. So you can gain or lose based on what they're doing. You could call that bet a derivative. Think of it the same in the stock. We could look at the role of the regulatory bodies like the Federal Reserve, the SEC, which regulates the markets. And we're going to talk about monetary policy and money movements within an economy. And I'm going to look for you to use real world examples and APA format. Connect these concepts on both micro and macro levels. Micro meaning we're looking at the individual choices, macro meaning we're looking at the entire economy. Use clear definitions and be concise. And then explain how inflation impacts the store value of medium exchange. Now, what is inflation? Inflation is when prices go up, but we're not getting any more of it, of anything. So that's a cost to us, right? So if I'm getting a 5% raise in my Social Security or my job or in anything or my investments, but prices are 10% more, I'm actually losing money because I could buy less. My purchasing power is less. And if I get a 5% raise and prices only go up 1%, then I'm actually getting ahead of the game. You want to talk about that and talk about how that affects you personally because there's a lot going on right now. And this is my estimated time commitments. So I want you to pay attention to that, okay? And I just put up a second guidance for week 2. So the first week is basically going to be understanding the financial system, right? Understanding financial systems, money and its role in the economy, and the function of money. And how do interest rates get determined? Well, we know that the Fed is in charge of either raising or lowering interest rates. How do they do that? They buy and sell treasury securities, basically. They have a lot of tools. Excuse me. They have a lot of tools, but their main tool is raising and lowering interest rates. And when they raise interest rates, they make money more expensive for everybody. They make money more expensive for everybody. And when they lower interest rates, they make money less expensive. So when they want the economy to grow, because we're in a recession, they're going to lower interest rates. They're going to make sure money is easier for people to borrow, to buy houses, to buy cars, and that's going to grow an economy. And when they think that the economy has too much inflation, like we saw afterwards, well, then they're going to raise interest rates and make money more expensive. So the main thing you want to remember is when the economy is in a recession, the government's going to want to lower interest rates. When the government is in inflationary times, then they're going to raise interest rates and slow down. Like when we had this inflation after post-pandemic, the government raised interest rates so we would buy less. So debt and interest rates are central to personal finance and a key to borrowing, lending, and investing, and they're essential for interpreting economic policies. You have bonds, you have loans, you have mortgages, and you have treasury bills and notes. And those are all ways people can borrow money. Either corporations or the government borrows by issuing bonds, which are basically notes that IOUs. They're basically fungible IOUs. Loans are the type of things we all take out, whether for cars or mortgages. And then a mortgage is a specific type of loan when you're backed by property that has collateral. That's why a loan that doesn't have any collateral is going to always be a higher interest rate than a loan that has collateral because the lender can't take anything back from you. Car loan, a house loan, those have low interest rates because they could seize that property. And then treasury bills and notes are what the government uses to borrow money. How debt works, that you borrow the money and then you have to pay interest. And the interest is the cost to the borrower. And eventually you have to give the whole principal back. So if you have a 10-year 5% loan on $10,000, every year you're going to pay $500, right? 5% of 10,000 is 500. And in the 10th year, you're going to give back the 10,000 plus the 500. We talked about it. Rising interest rates make money more expensive. Falling interest rates make money more available to people. And this is when the government really, this main thing, they have a lot of tools. But at the end of the day, when you're inflationary period, you raise rates. When you're in a recession, you lower rates. Okay, the Federal Reserve and other central banks play a crucial role in managing the cost of money. They will affect credit card rates, mortgage rates, corporate borrowing rates, and they do this to stabilize the economy. And that basically gives you a good view of what the first week is like, okay? In terms of what you need to do, the assignment there's your discussion. I think I gave you some information today in that discussion. And your assignment is going to be to create a written guide. So you should do, it's not going to be that difficult. Yes? Are you looking for me? And that's going to be what you need to do. That's going to be what you need to do there. I'm sorry for that. I heard somebody knocking. So that's it. I know it's a short class, but we're at the very beginning. We'll hold the class next week on Friday. This week I just couldn't do it. But it's great meeting all of you, and hopefully I'll see you next week.